In this video, traders, we're going to look at how dividends work. Stay tuned. Hey traders, a very warm welcome to you. So dividends, you're probably aware of them, right? It's something that the company pays out when they believe that they can't do anything better with the money. You know, a lot of companies make a lot of money and have a significant market cap before they start paying dividends. Dividends generally come from companies that have been around a long time. They've kind of got their market share, they're chugging away, the growth is slow, they can't really put the capital to that much good use, and so they're just rewarding shareholders for investing in the company. Other companies that are growing aggressively and are using the money that they're making to plow back into the business don't issue dividends, because why would you want them to? If they can make more money for you by putting it back into the business, you don't want a dividend. And actually, if you're choosing to invest in a stock that pays a dividend, you're obviously a specific type of investor who wants that cash flow, doesn't particularly want growth. Of course you want growth as well, but it's a ton of different decision that you're making as part of the portfolio that you're trying to create as a trader, or an investor, should I say. Right, so how do they actually work? So you've got the process. The process starts pretty much like this. The first part is the declaration date. This is the date when the actual directors get together, the board of directors, and say, yes, we're going to have a dividend. Then they'll have the date of record, or the ex-dividend date. And this is basically the date that you should be on the company's record as holding shares to receive that dividend. Of course, they've got to have a cutoff point because there's buying and selling going on all the time. So at some point, this date of record, if you're on the company's books as holding shares, you will then receive the dividend. We'll look at an example of that in a second. So that obviously means that because you've got so much back and forth and trade, they don't have to keep a record of who's on the books at any one time. All they've got to do is take a timestamp there, take all the information about who's a holder, who's not, process that through, and then they can process the dividend after that. But as I say, we'll go through an example in a second with that one. And then number 3 is the payment date. That's actually when you receive the dividend in your bank account or trading account, however it's distributed. And one thing to note, guys, is that many dividends are paid quarterly. So if it's a £1 dividend or 100-cent dividend, $1 dividend, it will be split up into quarters. Some pay it annually, but most do it in quarters. And that's obviously because it's got less impact on the actual share price itself. When stocks go ex-dividend, generally they will drop on that day, because theoretically it stops you from just buying just before the dividend and selling. Of course, it'd be free money. That if the stock didn't move, you could buy it, take your 50 cents and then just sell it straight away. So of course that's all encompassed into the whole move over the quarter, or the 4 quarters if you're looking at an annual dividend. So it kind of works out in the wash, but it's just to stop those short-term traders like perhaps me or you, if you're watching this, grabbing it before the ex-dividend date and making some money off it. Not to say you can't do that, because very often if it's a bullish market, you might buy it at ex-dividend date, you get the dividend and you get a little bit of a drawdown in price, but then it kind of gets sucked up by the market and you get that back. But that's then pure speculation as opposed to free money, so to speak. So yeah, many dividends are paid on quarterly as opposed to annually. Okay, so let's do an example now. Example could be that on the 8th of September, ABC company announces a dividend payable on the 3rd of October. So the board sits together, declaration date, they say, hey, we've made a decision, we're going to pay a dividend out. It's the 8th of September when they have the board meeting, and they say we're going to pay on the 3rd of October. Okay, they also say that shareholders on the company books, so the date of record, on or before the 18th of September, are entitled to dividend. So in other words, that's the time when they look at who is on the database of shareholders, and those are the guys who get, or girls, who get the dividend. However, there is something extra we need to think about. That is when the stock goes ex-dividend. An ex-dividend is basically the date 1 business day before the date of record when you need to have bought the stock. You can't buy it on the actual date, otherwise it's gone. You know, it's too late then. You have to buy it before 1 business day before the ex-dividend date. So if the stock goes ex-dividend date 1 business day before the record date. So if you bought the stock before the 15th of September, and the reason I say the 15th of September is because 18th of September we're Monday. If it was our Tuesday, it will be the 17th. I've got to point out here that it's business days, guys, obviously. You have to have bought it before that Friday to be entitled to the dividend. It goes ex-dividend on the Monday. You have to have bought it before that Friday. Well, technically it goes ex-dividend on the 15th, but the date of record when you have to be on the company's books is going to be 18th, and then you'll actually get the dividend into your bank account or trading account on the 3rd. So from a trader's, from an investor's perspective, it doesn't really matter how this works. You just got to be careful that potentially if you've held an investment for a period of time and you're coming up to the dividend payment, you probably want to hold at least until you get that dividend payment, because you've made all the effort of holding that, and this is some real specific reason you want to cover it, you want to close the position. So that's really one way of looking at it. From a trader's perspective, just be careful if you're trading and getting involved either long or short when the ex-dividend date is, because that's going to reprice the value of the stock. And if you're trading on CFDs, dividends will be treated slightly differently. You might receive, say, 90% of the dividend if you're long, and you'll have to pay out 100% if you're short. You need to look at the whole of the CFD provider or spread betting provider to see how that works. That's just their margin, admin margin, what have you. So it's not a fair deal either way, or it's not, should I say, symmetrical either way. But the other thing is, guys, if you're trading, and you've got to be aware when the dividend is, because not only will it potentially adjust the chart, which might look odd, and actually a lot of charts allow you to annotate them when they're automatically annotated as ex-dividend. So if you see a gap lower, it's not technical, it perhaps is just based on a pretty hefty dividend. So keep your eyes out for that one if you're trading stocks specifically. And also, be in mind that, if you've perhaps been in a trade and you're trading for the dividend play, is sometimes you get potential where stocks will start to run up towards that ex-dividend date as people don't sell, supply demand shifts a bit because they want to get that dividend. So you get some people coming in. How early that is kind of depends on the stock you're trading, but you might get a run up to the dividend where people who are in already don't want to sell, so the supply demand shifts that way, and extra people buying want to receive that dividend, so they start buying early or accumulating early. And so you get a double supply demand balance shift. But of course, when the dividend's paid, it's going to flip the other way. So, there's no free money there, but there is potentially a trading opportunity if you can understand and work out when the dividend's paid, how the stock is trading, etc., etc. All right, guys, how dividends work. See you next one. Take care. Bye-bye.